You open the chart and RSI shows 78, red zone, overbought, just like in the textbook. So you open a short position because the price is about to reverse. But the price keeps going. RSI moves to 85, then to 90, and it stays there for 3 more days until your stop loss triggers. Or the opposite situation, RSI drops below 30, you buy at the bottom, but there was no bottom there. In the end, it just becomes the start of downtrend. If this has ever happened to you, the problem is not you, and it's not the indicator. The problem is that you were taught to read RSI the wrong way. You were shown 2 levels, 30 and 70, and told sell above and buy below. This is the most costly simplified scheme in all of technical analysis. Today I will explain how this indicator really works, what it measures, what it doesn't measure, and how to use it in your trading so it gives you an edge instead of draining your account. I will cover everything in 3 steps. Step 1. Understand what RSI actually shows. Spoiler, it doesn't show whether an asset is expensive or cheap. It shows something completely different. And once you understand this, half of your mistakes will disappear on their own. Step 2. Adjust the indicator to fit your market and your time frame. The default settings are not a rule set in stone. They are just the default from book written in 1978. I will show you which parameters to change and the logic behind it. Step 3. Use RSI only as a confirmation tool within trading system. I will give you 3 specific working scenarios where RSI really gives you an edge, and I will tell you the situation where you should simply turn it off. A few words about myself, so you know who I am. I have been trading for 8 years, and that's not just a climb. My trading statistics are public on the exchange. The links is under this video. You can see not only my returns, but also my drawdowns and my losing sticks. I hold a master's degree in economics from Moscow State University. This matters not because of the diploma itself, but because it means I have a solid foundation in math, statistics, econometrics, and hypothesis testing. I am also the founder of a startup that went through venture funding. Investors don't give money for nice words, they give it for numbers and working model. The habit checking everything with numbers is exactly what I want to pass on to you in this video. So, step number 1. What does RSI actually measure? RSI stands for Relative Strength Index. It was created by Wells Wilder, an American engineer who moved into trading. He published RSI in 1978 in his book New Concepts in Technical Trading Systems. Here is how RSI is calculated. We take a period, 14 candles by default. Within that period, we add up all the upward moves separately and all the downward moves separately. We calculate the average for each group, then we divide the average upward moves by the average downward move, which gives us RS value. The formula then converts this into a range from 0 to 100. That's what the RSI formula looks like. I know, none of that makes much sense, so let's simplify it, explain it to me like I am 10 style. Imagine there are 2 teams, growth and drop. Every day they play 1 round, and one of them wins. If the price goes up by $3 in a day, team's growth wins the round with a strength of 3. If it drops by $5, team's drop wins with a strength of 5. We add up all teams' growth wins and divide by 40. 40 being the numbers of day in the period that give us the average strength of the growth. Let's say it's 6. And we do the same for team drop. And let's say we got 2. Now, to calculate RSI, we take the average growth strength, 6, and add it to the average drop strength. That gives us 8, and 6 out of 8 as a percentage is 0.75. So RSI is 75%, which signals that the buyers are strong. And right away it becomes clear why a high RSI doesn't simply mean it's expensive to buy right now. 75 just means that the buyers are winning more often and more convincingly. Notice something important. There is no actual price in this formula, no fair value, no volume, no market capitalization. There is only the ratio of upward strength to downward strength over the last 14 candles. So remember the key point. RSI doesn't measure whether something is expensive or cheap. RSI measures the speed and consistency of price movement. And RSI of 80 doesn't mean expensive. It means that over the last 40 candles, the growth has been almost non-stop. In other words, you are looking at a strong trend. Now, be honest, doesn't it make sense to sell an asset just because it's rising strongly and steadily? This is exactly where the standard approach breaks down. In a sideways market, high RSI values often really do signal a pullback, but in a trend, a high RSI confirms strength. It's not a reversal signal. During a strong trend, RSI can stay above 70 for weeks. It's not broken. That's exactly what it's supposed to show. This gives us the first practical rule I want you to take away from this video. Before you look at RSI, figure out the market structure. Is it trending or ranging right now? Without this step, any RSI signal is basically a coin flip. By the way, I have put together a short checklist covering everything from this video, a few pages long in PDF form. It covers step by step how to identify market structure, which settings to use, which signals to take and which to ignore. The PDF is on my Telegram channel, the link in the description and the pinned message. Step number 2. Settings for your market and time frame. A period of 14 and levels of 30 and 70 are just the indicator's default settings. Wilder tested this only commodity futures using daily chart back in the 1970s. You most likely trading a different instrument and a different time frame in a completely different market environment. So let's look at 3 parameters. First, the period. The shorter the period, the more sensitive the indicator. More signals, but also more noises. The longer the period, the fewer signals you get, but they are cleaner. Here are same general guidelines. A period of 7 to 9 is used for day trading. You will get a lot of readings that touch the extreme zones, and you will have to filter them strictly. A period of 40 works well for daily charts in general. A period of 21 to 25 is used for position trading on weekly charts, when you only want to see major imbalance and avoid reacting to small fluctuations. Second, the level. This point is the most underrated. The 30 and 70 levels are not a golden rule carved in stone. You need to adjust them depending on the market's direction. In an uptrend, RSI rarely drops all the way to 30. It tends to reserve around 40. So in a bull market, the working range is roughly 40 to 80. The 40 zone, sometimes even 50, acts as supports for buying, while 80 is just a reference point for overheating. In a downtrend, it's a mirror image. The working range is roughly 20 to 60. Bounces tend to stop around 55, sometimes 60, and that's the zone for entering short position. And how you can find your own levels. You don't need to guess. Just open your chart, go back a year, or better yet 2 years, and look at which RSI value the price reverses from most often. Every instrument has its own behavior. Index ETFs, Bitcoin and small cap stocks with all gives your different numbers. Third, price type and smoothing. By default, RSI is calculating using closing prices. That's correct in most cases. But if you are trading a very volatile instrument with long wicks, it can be worse calculate RSI based on the typical price, the average of the high, low and closes. You will get favor signals, but they will be more reliable. One more thing. Add a moving average on top of RSI with a period of 9 or 14. When RSI crosses its own moving average, it often gives an earlier and cleaner confirmation of reversal than simply leaving the extreme zone. All the specific numbers, periods and levels for trending and raging markets are laid out in a table in that same PDF checklist on my Telegram channel. Go check it out and subscribe. Step number 3. 3 scenarios where RSI really works. There is the most important point. RSI is not a trading system. It's a filter and confirmation tool. It doesn't answer the question, where should I enter? To long or for short position. It answers the question, should I trust the signal I am already seeing on the chart? Here are 3 scenarios where it gives you a real statistical edge. Scenario 1. Classic divergence on the edge of the structure. The price makes a new high, but RSI doesn't. In other words, the RSI peak is lower than the previous one. This means the move is continuing, but its strength is fading. The buyers are running out of steam. But there is a key condition that almost everyone misses. Divergence only matters at the edges of the structure, at a historical high, at a strong resistance level, or at the upper boundary of a channel. Divergence in the middle of a trend is just noise, and you should ignore it. You will see this kind of noise every day, and most of it means nothing. Scenario 2. The 40 and 60 zone as a trend filter. In my opinion, this is the most useful application of RSI, and almost nobody talks about it. In a healthy uptrend, RSI pulls back to the 40 or 50 zone during dips and bounces off it. It doesn't break below it. As soon as RSI during a pullback drops confidently below 40 and stays there. That's the first technical sign that the trend is losing its structure, even before this becomes visible on the price itself. The mirror image happens in a downtrend. Bounces stop at 50 and 60. And don't break trough. A confirmed break above that level is a signal that the downward move has run out of steam. Use it not for entries, but for managing your position. If the trend is healthy, hold the position. If the zone breaks, reduce your position or move closely your stop loss. Scenario 3. A return from the extreme zone, not simply being in it. The signal is not RSI is above 70. The signal is RSI was above 70 and came back below 70. Not RSI is below 30, but RSI was below 30 and moved back above 30. The difference is huge. And this scenario works almost exclusively in sideways markets. Now, the most common mistake. Most traders add another indicator right next to RSI that measures almost the exact same thing, just under a different name, which only reinforces their own arguments. So, it's worth going over what actually makes sense to pair with RSI and what to use instead. Stochastic and MACD makes sense to place next to RSI because their calculation logic is different. Williams indicator. This is essentially the same as the stochastic, just inverted and on a different scale from 0 to -100. It barely adds any new information compared to the stochastic. If you're already using the stochastic, you don't need a Williams indicator. MFI, Money Flow Index. This is calculated almost like RSI, but weighted by volume. So it answers not just how strong was the move, but also how much money was involved in it. The divergence between RSI and MFI is a strong signal. the price is rising, there is momentum, but there is no real money behind the move. This is by far the best partner for RSI on this whole list. It's the only one I had actually keep. Now let's put it all together. First, RSI doesn't show whether something is expensive or cheap. It shows the speed and consistency of the move. A high RSI in a trend is a sign of strength, not a reason to sell. So the rule is first identify the market structure, then look at the indicator. Second, the default settings of 40, 30 and 70 come from a book. They are not a law. Choose your period based on your typical trade lengths and shift the levels depending on the trend's direction. Third, RSI is a confirmation tool, not a trading system. The best partner for RSI is MFI because it adds volume real, new information. The other oscillators mostly just duplicate each other. That's all for today. Subscribe to the channel. In the next video, using these same rules, I will build a working indicators right in front of you and show you exactly how it's done.